Okay? So we've been talking about 99.5, right? What's 99.5 say, Sam?
Hold on.
Okay.
$995 is the non-recognition of gain or loss on contribution, disregarded entities converted to partnerships. Basically, SM LLC to a multi-member LLC.
So single member to multi. Okay? So we've gone from one member to two members, and there were two fact patterns. What were they?
Bring cash to the table or buy some shares.
Bring cash to or buy some shares. So as we've gone through this and we were having the call, I was not smart enough to recognize or be able to say this was 99.5. Because S1 owned 100% of P. And P was a single member LLC. And what happened was they introduced another entity where 7 million came in, and I can go to the page where there's 7 million cash coming in. There is loan or LP interest and AP interest. So A and A took a portion of their interest, contributed to SPP, and contributed to P. Okay? So don't worry about that piece, because we're going to come to that later. Okay? This piece is going to be part of Revenue Ruling 99-6, which we're going to cover today. This, where you have the introduction of the cash and LP and HAP interest and contribution, that was 99-5. So none of the assets moved at all. So when we were talking yesterday, I got a cash contribution, a contribution to partnership interest to SPP. SPP contributed those same things to P, which made P go from a single member, because it was single before that, correct? To multi-member by virtue of that contribution. And that constitutes from here, it constitutes a fair amount of what you're seeing up there. It is taking these assets right here, which resided in P. Those assets were legally titled in P. But when I do the analysis, I pretend they're not in P at all. They are I do a tax fiction that they were transferred. So as we were discussing this and you guys saw the call, it occurred to me that it's worthwhile saying that a portion of this transaction was Revenue Ruling 99-5. And that's worth knowing, because this has application. How much do we use 99.5, John?
Quite a bit.
Quite a bit. Okay, in the same way we use 99.5 for the F reorg, followed by the formless conversion. What do I mean by formless conversion, Kelsey?
Mirror?
Huh?
Is it like when you mirror? No?
Leslie?
Formless conversion? You're talking about like the Q sub or?
The Q sub is an ink.
And
the
it-
formless conversion does what?
Transfers it to an LLC.
Transforms.
Okay.
Not transfers.
Transforms.
Because if I was listening and somebody says transfers, I think the assets are being picked up and going from point A to point B. Transform means that the assets stay right where they're at, and the entity transfers from Inc. to LLC. And that way we have 99.5 as a tool to bring in somebody into the entity without causing us any problems or less problems. Okay? So I wanted to make that point. Now, today we're going to be talking about 99.5. We're going to be talking about 754. Excuse me, we're going to be talking about 99.6, 754. What else are we going to talk about? Oops, that's not what I wanted. Oh, we're going to talk briefly about cancellation of debt income, because I think that's worth knowing. John, is that worth knowing?
Yes.
Yes, it is. Sale or exchange of partnership interest, Revenue Ruling 99-6, And to the extent that we can get there, we're going to talk about 754. And if 754 becomes a casualty, I think we talk about 754 a fair amount, is my instinct. So if that turns into a casualty, I think that's closer to okay than not. But I defer to you guys in terms of what you think about that. So with that said, we're going to let John try to explain 707 and disguised sales.
All right. I would say when I'm thinking about disguised sales, generally you can move property in and out of a partnership tax-free, can come in tax-free, generally can come out tax-free. And if you try to use those partnership rules to your advantage to avoid tax, you might end up with this disguised sale. So in the simplest terms, like me and Brett, I put in land, he puts in cash. So I put in my land, I could take a cash distribution. Generally that would be tax-free, but it could be more like, actually there was a sale of land from me to Brett and we just funneled it through this partnership. So instead of me just giving Brett land and he gives me cash, we funnel it through this partnership. That could end up being a disguised sale. If all of that happens within 2 years, I think the presumption is that it's a disguised sale. And there's a list of like 10 factors that would point to a disguised sale. So if, all of this happens within 2 years, your starting point is it is a disguised sale. You'd look at these 10 factors and decide which side of it you came out on.
How do you do? Was it better? Is that for real?
Good explanation. I don't think your explanation was bad. I think it was just confusing on the.
So if we give you a fact pattern, can you now do it? Brad says yes. Brett says yes. Can you do it? Maybe, Alyssa?
Maybe. I can give it a try.
Give him a fact pattern, John.
So, for them to say, is it a disguised sale or
No,
not?
to solve for 704B, 704C, and what it looks like when the dust settles.
Well, it takes like a day for me to explain all that. You gave me like 30 seconds.
No, they've got the 704B and 704C. We spent like a day and a quarter. I think everybody's got 704C and 704B and a procedure down. Is that correct? On some level? They got that.
Okay, so the fact pattern would be I contribute $1 million of cash and Brett contributes $1 million of land, fair market value, and the tax basis is 0. And then a day later, Brett takes a distribution of $500,000.
Can't wait.
And I guess, so what does that mean? That'd be the question.
That's the question. What's the 704B? What's the 704C? What's the gain loss to John or Brett, to whoever the case may be? Should we do this together? What would be the first step? Based on John's explanation and my explanation, who could articulate what the first step should be?
I think you need to figure out, like Nate was saying, what's contributed to the partnership? What's everyone contributing?
Who said that?
From the rules Nate said yesterday,
Oh, okay. So what's being contributed to the partnership?
the land and the cash.
Okay. How much cash came out, John?
Million?
All million came out?
Oh, came out 500,000.
Yeah, I didn't put that up there. And who'd it go to?
Brett?
So let's say, I think you should change that the basis in Brett's land came in at 500,000.
Okay. Swear to God, I had a hard time articulating this yesterday because I can see it all in my head. I know exactly what's happening, and the fact I can't get it out of my head into words is driving me nuts.
It just, so you know where we're, I mean, I didn't say, hey, here's what you do when you have a disguised sale. I said, this fact pattern means you have a disguised sale.
Well, I think they got that.
Okay.
I think that you had at least that yesterday.
I didn't go any further than that. So that might need some more explanation as to what happens next.
Okay, so maybe, I'm having just a terrible time trying to articulate what this is. Maybe, John, you can tell me what you think of this. Maybe you should say, from a fair market value perspective, maybe this is step one. From a fair market value perspective, what is in the partnership when the dust settles? What's in the partnership, Sam, when the dust settles? Because John put in $1 million of cash, Brett put in land worth $1 million, and 500,000 left.
So what's left is 500,000 cash
So we got cash of 500,000.
and land.
And land, how much is that worth?
And land.
Okay, is that it?
So it's good.
1.5. So we have equity. How much equity does John have? What did he put in?
Then the cash is land.
$1 million. So John is $1 million. How much equity does Brett have? 500,000. Why isn't it $1 million? Because he got the distribution. So we have Brett with 500K. Okay, so now we have a fair market value balance sheet of what's there. Now the question I think you have to ask yourself, and again, I struggled terribly trying to explain this yesterday. John started with $1 million of cash. Brett started with $1 million of land. One of the parties, so maybe the next step is, what party got something out of the partnership, and identify who that person is. So who got something out of the partnership? Brett. Okay, so Brett is the guy that got something out, which resulted, as you diagnosed, $5 million of equity went down to 500, correct? Okay, so how did Brett go from having $1 million of equity at the beginning point to 500,000 at the end? What was that? Well, did Brett sell something? And did John buy something? Is that fair, John? Maybe?
I think so.
You got a better way of doing it? Or thinking about it?
No, yeah, I mean, I think that's where to start.
So, is it that John, pre them getting together, let's pretend, go to fiction, is it John paid, John has $1 million of cash, and he has land of 0. Brett has 0 cash and $1 million of land. Are you on board with that? I mean, that's what we have before we start. Well, John gives Brett 500K. And Brett gives John 500K of land. So post, now you have John with cash of 500, land of 500, and you have Brett with cash of 500 and land of 500. Does that make sense? Then you say, okay, John contributed 500,000 of cash. John contributed 500 grand of land, and Brett contributed 500 grand of land, and he retained the cash. So I don't know a better way to kind of to break this down other than maybe say step one when you have a disguised sale is what's the fair market value of the balance sheet when the dust settles? What was the starting point of who had what? And then think about what might have been exchanged to result in that fair market value balance sheet. I don't know, I can just see it. I can't, that's as good as an explanation as I can give it. I mean, you got anything better, John?
Yeah, it's hard to articulate. I think in my mind, I go through the same steps you do, which is, had we not run this all through the partnership, contribute land, contribute cash, distribute cash out to Brett, how would you have gotten there if the only step was a contribution? And in that case, the way you would have got there was, I would have sold, or
You would have purchased.
I would have purchased some land from Brett, and then we would have contributed it in. So yeah, I guess the analysis is how do you get there without running any of this through the partnership? And in this case, it'd be me to first buy some land from Brett, then we all contribute our land.
Okay, so Kelsey, based on my arrows, did we identify who contributed what in terms of the assets?
Yes.
Okay. Is that first step in 704?
Yes.
Okay, so what's my 704C balance sheet?
You have cash of 500,000, land 704C, land with a basis of, would it only be 250? Because he only contributed.
There were two contributions to land. So now you're addressing the Brett side of the
Okay.
contribution, but you also have to address the John side of the contribution.
So then your tax basis would be 500,000.
Plus, okay, so this piece that we have this exchange that occurred right here, correct?
Uh-huh.
John gave cash to Brett of 500,
Mm-hmm.
and Brett gave John land of 500. Is that a sale or exchange?
Yes.
Okay, so proceeds is what for Brett?
500.
What space is being utilized?
500.
Here's his basis. How much did he sell? It's a percentage.
Half.
Half. So how much basis do you think he should be able to use?
250.
Okay. Which leaves how much basis behind?
250.
Okay. So now Brett has cash at 250, or cash at 500, basis 250, gain at 250, correct?
Yes.
John has basis in that purchase ground of how much?
250.
How do you feel about that, Sam? Of 500, because that's what he paid. Okay, so let's do that again. Brett has basis of 500. He sold half.
So his basis is 250.
250 is used for sale,
Yep.
and 250 is remaining in the piece of ground left behind, correct?
Yeah.
Okay. So, but John's basis is how much in the ground he purchased?
500.
500, because that's what he paid. Okay. So John has basis of 500 in the ground, basis of 500 in his cash. Brett has basis of 500 in his cash, and basis of how much in his land?
250.
250.
Because the other 250 was used in the sale.
In the gain loss calc.
Okay.
Okay. So now let's go back to our 704C balance sheet. What assets was contributed by John,
Cash and land, both with basis of 500.
and what was contributed by Brett?
Land with a basis of 250.
Okay. So now let's construct our 704C balance sheet.
Cash of 500,
Yep.
land of 750.
704C, 500K, right?
Yep,
You're saying 750, right?
yep,
And you're saying how much is John's equity
a million,
and Brett's?
250.
250K. Okay, so maybe the procedure is John saying, treat it as if the cash never went in and came out. And I think I'm saying the same thing, except I went at it about a little differently to say, hey, what finished? And maybe that, and I think we are saying the same thing now that I'm saying it out. What is the ending fair market value balance sheet? What actually hit the balance sheet? What stayed? Then try to tie that to the beginning point of John had $1 million of cash, Brett had land, and the ending point was here. So what if we didn't engage, if we didn't put the money in the partnership and it come out, what would have had to happen to make this contribution true? Because John had equity of $1 million. He didn't get anything out of it. Brett had equity of $1 million, but he got 500. He retained 500,000 out of it. So now we have a data point in this midpoint to say, John still has $1 million. Brett only has 500,000. What would have to be true to go from John having $1 million in cash, 0 land, Brett having 0 cash, to $1 million in land? How did Brett get his cash? Well, Brett, outside the partnership, sold his ground to John, where now Brett has 500 of cash, 500 of ground, and John has 500 cash and land of 500. And then they go in. It's a fiction. Was that better? Because I didn't have any of you yesterday, except maybe Brett. Brett's looking at me like I had it yesterday. Did you have it yesterday?
I think.
I think you did too, actually. Okay. Let's see.
I had 2 questions.
Yeah.
If the cash doesn't go out, like the Sky sale purchase, basically on day 1 of the partnership, and it goes out a year into it, you have to redo all the basis in the balance sheet of the partnership to account for the disguise sale.
John?
I think at that point, that's when you'd pop the gain.
I think you got to go back to, my instinct is you got to go back to the original date of the I don't know the answer to this.
Because your tax basis would change at the partnership level with them.
But your tax basis, let's so when I don't know, I try to grab onto stuff I do know, right? To try to analyze, or Sam, diagnose what's going on. So your question is, if I get the cash a year later and it comes out of the partnership, what's my gain? I think it's the basis of your question.
Well,
How do I
the
calculate
gain would be the same because you just go back to day 1 and figure your gain. But I'm saying at the partnership entity level, do you have to redo your balance sheet because the tax basis of the contributed
From a 704C perspective?
the tax basis of the contributed assets would have changed from
100%, yes. 100% that's true.
okay.
Okay. So I thought you were asking if the basis was going to change, or you had to adjust.
No, the gain would still be the same.
Okay.
Okay. Other question: can you hide a disguised sale through the waterfall stuff we talked yesterday about? Or is that combining too many different things?
How do you feel about that, John?
So I think the presumption, if it happens within 2 years, is that it's a disguised sale. So I mean, I don't think.
Well, but his point is well taken, actually.
It's hidden. It's hidden within a waterfall provision.
What he's saying, okay, so let's back up, because that's a great question. And now I'm sad I didn't think of it. Is that he's saying Pete and John are 50-50 partners, or Brett and John are 50-50 partners, or 2/3, 1/3, because that's how this math works, 2/3, 1/3. And he's saying, well, wait a minute. You know, if the cash is coming out disproportionately because we're 2/3, 1/3. But what Brett's saying, which is worth exploring and thinking about, is, well, what if we say that this comes in, okay? John's cash comes in at $1 million. Your ground comes in $1 million, and we have a dispute over the economics, or negotiation is a better way of saying it. We have a negotiation. And we say, the only way we're going to get in this thing together is if I have a preferred return. Correct? And or I have a preferred liquidation right, or I have a preferred spot in a waterfall. And what's going to happen is I get the first distribution out of the partnership under this preferred right is $500,000. And it's stated in the partnership agreement. And then, you know, what happens after that is we're 2/3, 1/3 on an income split. And now I think what you're saying is I've now created a set of steps in a waterfall that harvest out the $500, $500,000 maybe, and make it not look like a disguised sale even though it was.
So I've done that.
Oh, he's done that.
Yeah, and so I think you can, but I think my fact pattern was,
Maybe you should give him the gift card.
yeah, that'd be good. So everybody contributed land, and then the way I felt comfortable with it was, you know, I think that there has to be some appreciation for that to pass the smell test. You know, if it's just the land goes in, you immediately kick out $500,000. I don't think that works, because I think you want to substantiate why that distribution's coming out. In my case, you know, varying parties put land in, some level of development happened, and I think you could point to, hey, this land's worth more today than it was when this all happened. And that economic uncertainty, I think, helps you past one of the disguised sale rules. So when you roll all this stuff in, if you know this is going to happen, that's bad. But if you roll all
Hold
this,
on, so the rule we've kind of given as a general rule is anything that happens is while we're partners should affect everybody's 704B cap count equally or pursuant to the rules.
right?
Okay, so how did you take appreciation that occurred while everybody was a partner and direct it to a specific person and defeat the disguise sale rule? Because you're saying it went in, no appreciation, it appreciated post while we were partners, and now I've got cash coming out to defeat the disguise sale rule. How did you make that work?
So, you know, it didn't happen immediately. It happened, you know, a year down the road, or,
But why didn't everybody participate equally in that appreciation or pursuant to whatever the rules were in the partnership?
well, they did participate pursuant to the rules in the partnership
And
agreement.
the rules were what?
That the first amount of appreciation went to the partner that was gonna take the distribution out.
Okay, so you gave them a preferred income right associated with that appreciation. Correct. Okay, all right. See, if I don't know, I tend to ask questions trying to figure out what the hell's going on. Okay?
And so, yeah, I think what makes that work is that you have to have some amount of and the way we paid for it was we refinanced and got debt after I think some of the development had happened. So, it felt okay to me because certain things had to happen. There actually had to be appreciation before we could kick that distribution out.
Well, hold on. So let's stop there for a second. So there was no step up, and you took that distribution as there was no distribution in excess. You just hit basis for that distribution, correct?
I think so, yeah.
Okay, all right. Does anybody have any questions about that, about disguise sales? Have we beaten that horse enough? Okay, taxable year considerations. John, are you any good at taxable years?
No.
Oh, you guys are equally screwed. So, one of the reasons I put this in here was that a partnership's tax year, there's a couple things that we should know. One is the partnership's tax year is going to be dictated by the majority owner. So whoever has the largest interest in the partnership is going to dictate the tax year end for the partnership. So if you have a C Corp with a 6/30 year end and they own 51% of the partnership's automatically going to default to 6/30. That's how that works. So
That's not my understanding, but
what's your understanding?
I thought you had to run through, I think a lot of times you end up there, but I thought you had to look at all your partners and say, which tax year gives us the least amount of deferral,
That's only if it's not clear who has the majority.
okay?
Okay, so that's another rule. So it's the first rule is who has the majority. That's the first rule. So if you have somebody that has 51% or more of the partnership, then they're going to dictate what year is inflicted on the partnership. Or so A has a tax year end of 12/31 and B has a tax year of 9/30. Under scenario 1 to the left, A owns with 51%. Noodles, what's the tax year end?
12/31.
Okay? And A owns 49% and B owns 51%. What's the tax year end?
9/30.
9/30. Okay, so it is as simple, I think, that the majority owner is going to dictate the tax year that the partnership's going to have. So what John's talking about is what if A owns 50% and B owns 50%? Does anybody have a majority ownership in that partnership? So what John's saying is that in that case, you have to examine who your partners are and what would be the least amount of deferral that would occur. And how that analysis really works, I've never really understood. But here's what I think it says.
The one
Well-
time I did it, I ended up with the opposite result of what I thought of it.
What you thought? So in this case, if it's 50-50, my instinct is it's 12/31. Because 9/30 is going to result in a deferral for A. Correct?
Correct.
And if we go to if we're at 12/31, if 12/31 is our year end, meaning January 1st is the first day of our year, then we're going to have a K1 issued. Well, do we have an equal amount of deferral?
I couldn't even articulate it. I'd have to just step through it because the one time I did it, it was the opposite of what I thought. So I wouldn't.
Like I said, I don't know these rules. So a majority of the time you're going to have, it sounds like the exact same amount of deferral, John. Let's find out.
Maybe you should put it at instead of 6/30, 7/31, because you might just have an odd result since they're 6 months apart. I don't know.
Well, but let's stick with 9/30 just because to prove out whether my thinking's right. And now, just so you know, we're genuinely guessing. So if you have 1/1 and you have 12/31 and you have 9/30 and you have 9/30. So if we start as of 9/30, then we're going to call this year 1, and we're going to call this year 2. If you have a 9/30 year end, and we have income on November 1st, we start on November 1st, we would have income through 9/30, and we would have a K1 for full year And we have A is 12/31, is that right? And B is 9/30, is that correct? Well, if this is true, then you have A is going to have a full year's tax return, full year amount on their tax return, because they're not going to have a tax return due until 12/31, correct? So A is going to have a full year on their tax return. B is going to have a full year on the tax return because they have the same year end, correct? But if you have it in the alternative, we start Jan 1, then our full year goes here, and B is not going to get a tax or a K1 at 9/30, are they? Because the partnership hasn't completed its year. So this is L1 partnership that has A and B as partners. If we have a full year starting January 1st and we have a 12/30 year 1, L1's going to have a tax return due associated with 12/31, correct? B has a tax year end here. Associated with that tax year end, is B going to have a K1 to report on that year? They're not. So now, by virtue of starting January 1st, B has a deferral, correct? Yes? So it almost feels like it's the least amount of deferral, 9/30?
I think so.
That went 180 degrees of what I expected it to do, just like John said. Because, again, if we start at 9/30, B's not going to get any deferral. Because L1 is going to have a tax year that goes all the way to here. L1 is going to give a K1 to A and B. B now files his tax return. B now has a K1 from L1 by virtue of this start date. Correct? A has a 12/31 year end, and A has a 9/30 year end K1 that it gets to report on its return. Let's go with, I don't know these rules, but you get that they exist. And how often are you going to have, you've dealt with this once? I've dealt with it once, and I just know the rule exists.
So if you have 3 partners and the greatest ownership by one partner is 40%, that's not considered the majority where you have to use their tax year?
I think it's a majority ownership. I think it's more, I think so. Because if you're down to 40%, at that point, you could have 40% at 9/30 and 2/30s at 12/31. And now, which has the least amount of deferral? You have one at 30% at 6:30, and the other at 12/31. I think you have to do an analysis of the partners and how that income is going to kick in. Right?
I think so.
I think so too. Let's go with, there's the third answer or the second answer of I don't know. So when I'm pretty confident that if you have a more than 50% owner, you're going to have a tax year end. And if you, more likely than not, you're going to have all your partners have this exact same year end of 12/31. So there's 2 things that really turn off this analysis. One is all your partners have the same year end. And that turns off the analysis because there is the least amount of deferrals, everybody's on the same year end. And the second is majority ownership. We don't confront this a lot, but it's worth knowing that the tax year is dictated by dictated by the partners. that own it. Okay, this is about tax year end that is, we'll talk about it for a second. A valid business purpose says you can go to the IRS and say, I don't care what your rule says. I have a business purpose for wanting a tax year end other than 12/31 or the least common deferral or however that determination was made. And that the general example of that is going to be the ski slope that does business from late or early November through early May. They're never going to have a tax year end in that window, and their tax year end might be June 30 because everybody goes away, and that's when they can catch their breath. And there's gross receipt tests that come with that and other things that you have to jump through. But how often do we deal with that, John? Never?
Yeah.
That's a never. Okay, who remembers from 2 the 444 election? Brett?
I remember talking about it.
You remember what it does?
It has to do something with choosing your year end and filing within so many days to have that be allowed.
Okay, so you know that sheet that I keep going back to for standard? Guess what they had?
Year end.
They do.
Yeah.
But when I drew the boxes up here, the P entity,
Mm-hmm.
well, actually, we just did this analysis, or somebody just did this analysis. So there's 100 million that came into Passel, or P. And on our side, we had 40 million from Standard and 10 million from Friends and Family, roughly, to get to the 40, or the 50, excuse me. And the other partner brought in, 50 million of cash. So are we 50-50 at that point, John?
Didn't you say it was 10, 40, and 50?
Well, the other side, yeah, 40 and 10 would go together.
Okay, 50-50.
So it's Standard, Friends and Family. I'm counting them as one contributing group. It's 50-50. And what's Standard's year end?
9:30.
And the other party that brought in the 50 happens to be 12/31.
Okay.
So there was this brief moment of having a conversation about the least amount of deferral and how that worked, which in Standard wants a 9/30 year end. So the least common deferral, actually, I look at that, I don't understand it, and quite frankly, if I don't have to learn it between now and what do I want to do?
Retire.
Retire. If I can avoid learning that between now and when I retire, I'm good. I don't need to do it. You people can learn that stuff right along with basis schedules and this BOI bullshit and whatever else that's out there. Does that affect my world? BOI?
Yes.
How?
What if your client gets a penalty?
Do we have to do anything with it?
You gotta,
I thought we put that in the lawyer's lap.
yeah, but they'll be pissed if you didn't tell them.
Sam, what do I want to do?
Retire.
Why?
So you don't have to
Shit
deal
like
with
this.
the bullshit.
Okay. Anyway, I've gone into a ditch here. What were we talking about? Oh, Standard. Standard has 9/30. The other side has 12/31. We're 50-50. Now we're talking about least common deferral. But we have the 444 election. What the 444 election states is that other than a required year end, wait a minute. Okay, I'm gonna go get them, actually. Other than a required year end is defined as 12/31. You can have, by election, November year end, an October year end, or a September year end. And it's freebie. You can just elect to have that. So as we were dealing with Standard, and now we're confronted with this 50-50 ownership, and now we're confronted with this least common deferral analysis that, do I want to learn that, Sam?
What?
Do I want to learn the least common deferral? I don't. but I got out of it by a 444 election.
I think 930 would have been your least deferral anyways.
According to that.
Yeah.
But what do I know? What do I know? Okay. And I'm going to see if Ty's out there, because he actually learned a little bit about 444, and he might want to tell us some things that he learned. I'm going to see if he wants to, because it was worth knowing, and he taught me stuff I didn't know. I'll be right back. Okay, so we're talking about 444 election, Ty,
Yep.
and I said, I kind of know it. Ty kicked my ass a couple times on this. What can you tell this group about 444 elections?
Okay. 444 elections are, I would say this is for clients who operationally want to have a fiscal year end. It's not necessarily a tax advantage to go to I'm gonna use 930 year end for reference. So
Let's go, because that's the one we're talking about.
yeah. So again, this 444 election is, hey, you want to change your tax year end to 930, 1030, or 1130. And again, we had a client who wanted to do this because they just operationally, they do summer basketball. And so like their kind of natural end of the year is end of the summer. So they wanted to get to a fiscal year end. And so we were like, okay, we can go to a 930 year end. And again, the point they wanted to do it was operationally. There's not a tax advantage because when you think about, okay, I'm sure you guys have seen this. You work on standard, right? So it's the same thing with standard. And so say it's a 930 23 year end. Well, 930 23 is going to be picked up on the 2023 tax return, and then
In 2024.
2024. Okay, that's right.
Yep.
And so, but then those last 3 months aren't going to be picked up until even the following year. And so there's kind of this deferral of income because it's not getting picked up on the that year's return. It's getting pushed out a year. So the IRS says, hey, because you're deferring these 3 months, we're going to take, whatever your normal 12-month period was, or, on the tax reporting period. They say, okay, hey, how much income are you deferring? 3 months. So that's a quarter of the year. So they say, okay, whatever's on your last filed tax return here, times it by a quarter, and you need to have a payment on deposit with the IRS at the highest tax rate, which is 38%. So a lot of times, and for us specifically, it's actually kind of a ding on the client to make this election purely from a tax standpoint. But it may, again, for these guys, it may make sense for them to still want to do it operationally because, again, the payment on deposit at the IRS with the IRS is at 38%, and anyone else's max tax rate will be 29.6 after QBI. So it's kind of a disadvantageous thing to do from a purely a tax and kind of time value of money standpoint, but you're going to have clients who, hey, operationally, and again, the world is bigger than just us tax folk, and so operationally, they might want to have it on a 930 year end. So that's kind of the background of why you see it sometimes and kind of why that is important for, when we got to think about stuff. And so I guess this payment on deposit, how this works functionally is, so you'll do your 930, we'll do 930-24 year end. And you just, file the return like you normally do, 930 year end. And then after 12/31 is when basically into the next year is when this payment on deposit form comes out. It's called the 8752.
Due May 15th.
Due May 15th. Yep. And so you fill it out.
And let's pretend that the client has $1.2 million of income.
Okay. So working through the numbers there, say we did the 10/1/23 to 9/30/24, and they had $1.2 million of income. And then you think to yourself, okay, so you can file the return, as soon as you want to after 9/30. So in the next month, next 2 months, but you cannot file that 8752 in conjunction with that filed return because these forms don't come out until, the next calendar year. And so that's where 3 months or 4 months down the line, you'll kind of revisit the tax return you just did with the 1.2 million of income. And you say, okay, and then you go through the form, and it's a pretty simple form. It's a one-pager that says, okay, what was the last, filed tax returns income? 1.2. How many months of the year are you deferring to the even the next year? which is, 3 months, which is 0.2, 25% of the year. So they say, okay, well, assuming that income is smooth, throughout the next year too, theoretically, these next 3 months are going to be, a quarter of what the prior filing was, which would be, 300,000. So how the form works, and pretend this is year one, how the form works is they say, okay, 300,000 of income that you're not picking up on this, next tax return that you should, that's getting pushed off. So they're saying you got to put a payment on deposit, and they times it by 38%. So the math is, 300,000 times 38%, which is little under 120,000 or something like that. You got to pay that to the IRS before May 15th of that following year. And so that's year one. And again, with it being a payment on deposit, it's kind of a rolling calc. So say next year we have the exact same amount of income. So, 1.2 million, we go through the exact same calc. We say, okay, we're deferring 300,000 of income. What should our payment on deposit be this year? And we're going to get to the same 120,000. So year two, you don't need to make a payment in because you've already paid in last year that 120,000. And so it kind of moves. So say income goes up to 1.6 million.
Well, let's go to zero.
Or let's go to that's easier. So let's go to zero. Say year two, we have a loss, and we go through our calc. Okay, what's 38, what's 25% of zero? What's the 38% tax rate of zero? It's zero. And it says, okay, what should your payment on deposit be? Zero. What is currently on deposit? The prior year's 120. So you get to get that back. So every year you go through a calc that says, what should the payment on deposit be? You compare that to what do you currently have on deposit, and then you either get a refund or have to pay in based on that, because it's just a rolling calc every year of what should be on deposit with the IRS to not let you take advantage of just pushing income to basically 2 years down the line rather than one rather than zero. So that's kind of the background of why some people do that and why you may or may not want to do it from a tax standpoint. But does that make sense, or what questions you have on at least the background?
Do you remember what you taught me?
Okay, so
Because I think this is absolute bullshit.
yeah, so the weird thing, so again, what we've established here is that the IRS does not get screwed in this situation. The original fear is, hey, if we only pick up 9 months of the year, of the current year, on our tax return, and everyone else has to pick up all 12, you're kind of getting ahead by not having to pick up that last 3 months until the following year. And so that's the fear that you're kind of getting away with something, but they fixed it with this, hey, you got to have this payment on deposit for the final 3 months. And not only is it at your 1040 tax rate, it's at the 38%, which is wildly bigger than, what you'd actually be taxed at. So what we've established is the IRS does not get screwed in this situation. So you would think it'd be pretty easy to make this election, but they do make it more difficult than it needs to be. So I guess this would be specific to partnerships and S corps. So I think C corp, it might be a different section, but C corps kind of get to choose whatever they want, I think.
Because
So-
there's no deferral.
Okay, yeah. So, great point. So, again, specific to partnerships and S corps here, you'd think it'd be pretty easy and not many hoops to jump through to do this because the IRS does not get screwed in this sense. It's more of an operational, for the benefit of the client, keeping their books on what they view as their natural year type situation. However, you can only make this election, at least the two rules that we had to do a lot of research in with this client that came on this last year, is one, you can only make this election basically in conjunction with their first year of filing. So you can't be a 12/31 year end in year one and decide you want to change it in year two. It's got to be the very first year end you have. So that's part one, which can trip people up sometimes. And part two, hey, who's worked on a return in here where it's a tiered structure, meaning it's not a partnership and S corp and we only have individual owners. We've got partnerships kicking out K1s or partnerships kicking out K1 to partnerships and S corps, or partnerships and kicking out more income to partnerships. I mean, everyone here has worked on a tiered structure of tax returns. So the other piece is they say, hey, when you're part of this kind of group of returns of related entities, everyone has to be on the same year end. You can't have random pieces in the tree that have a 9/30 year end and other people are others. They say everything has to be the same. There's certain de minimis rules of like, hey, if it's only owns 5% of an entity or less or something like that. I forget exactly what the rules are. Those particular ones don't have to be the same 9/30 year end, but by and large, everything within this ownership tree needs to be a 9/30 year end. So, which gets you to the fun piece, which is what what Pete, talked to me about, is we had an issue where, we had a client come to us and they said they wanted to be a 9/30 year end, and they were an existing partnership and S corp and group, and we were like, oh yeah, no problem, we do that all the time. And then they come over and it's like, oh crap, like there's a lot more of this than what we thought. And so, kind of one thing to be aware of is, and what we came to is, hey, we had a partnership that basically, went from a partnership to an S corp in a year. And with that being a deemed liquidation of the partnership and, I forget the lingo, but, turning into an S corp, we got to treat that S corp as if it was, its first year of operation, and therefore be able to, meet that requirement of, hey, first year time, the first year is the only time you can make this 444 election. And then with that S corp owning everything else in the tree and everything else being partnerships have one of their required year ends is to match the majority owners. Like that's not an election, that's a requirement for partnerships. And so with the S corp switching to a 9/30 year end and the partnerships all automatically switching to the 9-year end, we're able to meet both the, hey, it needs to be in the first year of operation, at this level for us particularly, and also everything within the tree needed to be at 9/30 year end too. So all that to say, there's a lot of different rules that go into this, even though you'd think it wouldn't be. But that's kind of what we did a lot of research in, at the start of the year here to kind of help a client get what they wanted.
So the thing that I learned that freaked me out was it had to be in the initial year. I've been around since 1996, and I've always thought you can make this anytime. I had no idea that, and on top of it, I had made it for people not in the initial year and never got 1 ounce of pushback, ever. So that kind of freaked me out. The other thing that's worth knowing and is worth putting, I don't care where you put it, but it should be in an important page with a highlight and a post-it on it, is this, what I'm about ready to, and I've said this before, is if you have a late election associated with 444, or you have a late election with respect to 754, and you catch both of them within 1 year, you have relief to make the election under 301, what is it, Ty, do you remember?
Not exactly, but it's at the top of that 8716. I know.
It is. Campy? 301.9100-2. That is an awesome rule to know, especially, Lutz has missed a 754, and we've caught it within the first year, and we filed for this 9100 relief to get the 754 election. This is a really, really good rule to know from a 444 election perspective and a 754 election. Because if we missed it, we can, and we're within a year, we can get a 754 election in to capture the step up. Better yet, if a different service provider misses it and we know the rule, we can say, well, we can still go get it. So, and then we look like geniuses. In one case, we're saving our bacon. In the other case, we look like geniuses.
And thinking big picture here, Pete, so typically you'd get, 3 years to amend a return, right? But these are things that you only get a year to go back and fix, the 754 and the 444 election.
So, Mr. Campy is the guy I told you to go to for qualified non-recourse deductions, minimum gain chargeback, qualified income offset. What else, Campy, that I tell him to go to you?
Todd wasn't here.
I That's piece he's educated himself significantly on. What I would argue is the world's weirdest client fact pattern I've ever encountered. And I think if it gets weirder than that, I will retire. It is so weird. I don't know what to do with myself. And then Ty actually did a fair amount of research and did a really, really nice job with respect to trying to understand the 444 election and how it works, and how the levers pull. Because every time I called, Ty called, yeah, that makes sense. And then I get another call. He said, well, what about this? And I said, I didn't know that existed. So Ty did a really, really nice job of trying to figure this out.
Thank you, Pete. And so the background there is you guys are going to get to the point where kind of your butts are on the line and you kind of need to research different things, and you're just going to get better at it because, as you know, the lingo is just a little different in the code and in the regs and things like that. You get a lot better at it, but all the time is you're going to read these things and you always want to run it by, like a Pete or someone else who maybe knows more of the real life of, hey, I've done this before in practice. So you always want to pair those two together. You want to do your research, kind of read through it and come up with what you think, and then, run it by someone with a little bit more experience for you. And then going back to that, kind of 1 year late relief, that's exactly what we did on our client fact pattern too, because we originally said, oh, hey, we'll file a 12/31/23 return, and then we'll switch the year end to 9/30/24. We found out, oh, we can't do that for existing. And we just kind of luckily, happenstance, the prior CPA filed an S-Corp election for 2023. So we said, oh, our first fiscal year end needs to be 9/30/23 and then start rolling from there. And this is, April 2024. And so we were able to use that 1 year late relief to get us by I think it was a 5/15, deadline to get us to where we needed to be. So, the late relief, like Pete was saying, is also really valuable to know when are we too late or when can we go back and get things the way we want them to be, basically.
So 444 election doesn't come around a lot. I mean, it's not like an everyday garden variety thing. I mean, for 40 elections to be done, maybe. Yanni?
No, and I've got some clients that apparently did them, but
Okay, but it's something that is more than worth knowing it exists, because it is something that we can utilize as a tool. It's more than zero. I mean, it's not super common, but it's more than zero.
Yeah, I guess kind of one more random piece of advice here is, so we know our requirements for the 444 election is there's probably various different ones, but the two big ones that we ran into is it's got to be your first year and everything in the tree needs to be, the same year end. However, if you meet those two, you can kind of just choose to have these 9/30, 10/30, 11/30 year ends. The other thing we looked into for this client but didn't meet is that if you have quote unquote this natural year end, I believe, and it's a bigger client where the number's a little bit bigger, you can file to have that like a natural year end, and you don't need to do this payment on deposit with the IRS and stuff. But I think you need to meet this. I think it's 25% of your gross receipts need to happen in the last 2 months of the fiscal year. Say that again, or something, or last quarter, might be that. One of the two. And then also, I think talking with Dan, you need to get like a private letter ruling in order to do that. Does that sound right too? It's not automatic, yeah. So that, if you're working on a gigantic client where like, oh, 10 grand for a private letter ruling is nothing, we'd like to get this done, that's an option. But otherwise, this is the much more common of the two, but just know that that's out there somewhere. If you
10 grand.
say that again.
Where did you get the 10 grand number from?
I think that's what Dan said. Is it more expensive or less?
I thought it was like 100 now.
It might be that.
Have you ever done a private letter ruling?
I have not. And if I can avoid that one, I would like to avoid that one well.
I'm gonna start doing one.
Leslie's gonna be doing one.
So,
Okay.
Okay.
That's why I asked.
Sweeney told us it'd be like 30 for the one that we're gonna be working on here in the next couple months. When I say we, I mean.
I think that might be just the filing requirement of the IRS.
I thought he said application fee or whatever is like 5 or 10 grand, and then our time would make up the rest.
Okay, I don't know. I thought,
And I think maybe that's specific. I think that's maybe specific to the type of PLR we're
I
requesting.
think that's right too.
For different types of matters, the fee is more.
I know Steve Kenny's done two or three. You know, he's the only one in the office I know that's actually done a PLR. And I know people, if we need to ask questions, but to say I have extensive experience with PLRs,
We have
no.
some examples to go off of, and Steve Kenny, and I can't remember if there was anyone else.
Sweeney did one with somebody in Hastings years ago. I don't think it was Brad vaguely, but
Josh.
whoever it was, he said was a stickler for the rules, and he showed it to me. I mean, it's like a 50-page document with every little detail in there that you would possibly need.
Yeah.
We're trying to clean up a prior accountant's mess on this one.
Is it what's his name?
Yes.
Spelled weird. Yeah. Yeah. That's what I thought you were gonna say. So, and actually I brought up on this page the 3100 or 301 9100 relief for the 444 election. What's it has to be filed within.
May 15th of like the year you want to do it.
That's the date. I
Yeah.
can remember. That seems right, but I couldn't remember what it was when I was writing this. So May 15th is the date. 9:30, 10:31, or 11:30 year end. See, I even got Ty Barsley. Ty Barsley had a shout out in here: "Is go talk to Ty, not me."
I love
about the 444 election. And go talk to John about non-recourse deductions, qualified income offsets, and minimum gain chargeback. Not me. See, this is my transition right here. I'm just telling people to go talk to other people about other stuff I don't want to talk about.